The stock market tumbled 800 points in a single day on Tuesday's trading session. This couldn't be at a more interesting time. We just had renewed optimism about the economy, about stocks, and about trade issues. In a complete 180-degree spin, everything changed in a 24-hour period. But what changed? What happened? Well, the truth is not connected to the behavior of the stock market. And that's why you came here for the truth. So let me unveil that for you. Today we're going to look at what has happened with the inversion of the yield curve. I want to give you some details on that. I want to show you what happened in the stock markets. I want to take a look at the Asian markets as well. Never forget about what's coming around the bend. I'll give you that in just a second, but first, a little humor. You can see this individual here, and it truly represents the way that people feel when they've made the wrong move. Now, I don't know if this picture was actually taken in today's trading session, but it doesn't matter. Ultimately, what we're looking at here is an individual who clearly feels bad about their decisions, about the situation. Maybe he's worried about his job. Maybe he's worried about what has occurred here. And this is really just a picture being worth 1,000 words. That's the way I look at it. That really brings me into the video for today. Asian stocks stumble following Wall Street plunge. Stocks in Asia traded down on Wednesday morning after an overnight plunge on Wall Street as investors worried about a potential economic slowdown. And what I found interesting about this was that they're calling this fall a result of a potential economic slowdown. Not about jobs, not about the Federal Reserve, not about the trade issues, just a potential economic slowdown. And is that a reason for the stock market and the Dow Jones to drop 800 points? Does that make any sense? Of course not. Of course not. This is not true. Now, the true reason goes far beyond that. Perhaps it has something to do with the Federal Reserve. Perhaps it's the tweets that were sent out. Perhaps it's the trade issues related to that. Perhaps we're looking at deeper factors here that are not to do with the generic potential economic slowdown. Overnight on Wall Street, stocks saw a sell-off with concerns triggered after the 3-year Treasury note surpassed its 5-year counterpart on Monday. That is the information that we're getting right now, seeing the inversion of the yields. I did a video about that just previous to this one. If you haven't seen it yet, definitely check it out. I highlight all the details from there. They also get into the trade issues in this article to talk further about that, but I just wanted to give you an idea of what has happened. Of course, this always spreads. If you have a problem in one country or in one area, one continent, it's going to spread to the others. Sure, they might be less or more affected by what has happened in a particular country, but eventually it spreads around. This right here is the 10-2-year Treasury yield spread chart, and you're seeing today, as I record this, December 4th, it's at 0.11%. This is the granddaddy. This is the big kahuna. This is the one that they're waiting for, the 10 and the 2. We looked at the other ones earlier in the video I did, but right now, what we're waiting for is for this to invert as well. And you can see over the past 5 years where it has gone. Clearly, it's going to invert. We have no doubt about that. Whether it happens tomorrow or next week or next year, that's what is still needing to be determined. Now, you can see that it has dropped significantly in the last little while. I can see the chart at the bottom here, just outlining every day what it was at. On November 30th, it was at 0.21. On December 4th, it's at 0.11. So we could see it halved in a very short period of time, in just a few trading days. So looking at this gives me the idea that we're not too far off from the inversion of the 10-2-year. And when I see that, I have to start thinking, okay, now we are borrowed time. We are on borrowed time here. How long it's going to take, I have no idea, but this is the preeminent recession indicator for traders, stock analysts, and so on. This right here tells us that we are fundamentally broken. This always happens before a recession. Why and how exactly are all of these things behind the scenes working? You don't need to know all of the ins and outs. A lot of these indicators are simply there to be so confusing, so convoluted, and they really aren't that important. But when you take them as a whole, you don't take one indicator, you don't take 2 or 3 or 5 or 10, you start to look at hundreds and hundreds, you piece it all together, and it starts to make a lot of sense. But that means you have to look into the details, that means you have to be brave, and that means that you have to know what's happening on the surface level as well as multiple layers deep. So you're going to find out what's happening in the mainstream media. You're going to go and dig deeper into what's going on in the charts. You got to look at the details that are not being covered necessarily, but you can pick pieces together and figure out the whole picture. This is the S&P 500 in the top right, and all of the other US markets, all of them have moved under their 200-day moving averages once again. You're looking at this at a time when the markets are struggling. No matter where you look, whether it's US, whether it's around the world, the markets are not doing well. This has been the case all throughout 2018. They have really struggled, and it continues to be a problem today. We are in December, and approximately, last time I checked, 90% of assets are going to have a negative return. That's not good. That's not going to look good on them into 2019, of course. They want to push the markets up. I keep hearing about this whole business that they're going to be all-time new highs before the end of the year. We'll see if that happens. Usually there would be some sort of fake confidence between now and the end of the year because people are spending a lot of money. They'll probably get some good reports out from the government. They'll, pad them and make sure that they look real pretty. Of course, we'll see. But this here just shows us that on the technical indicator side, it's not looking good at all. Speaking of technicals, we can see what has happened to our favorite, the FANG stocks. Now, if you're like me and you're holding 7 shares of FANG, then you know what has occurred in the recent past, looking at the FANG stocks, seeing how they just absolutely got destroyed yet again. And these are the stocks that go up very fast and come down even faster. We looked at these stocks over the last little while and how they have been absolutely beaten up. They are in a bear market as I record this video, and that shows us the actual true weakness that is underlying these stocks. People believe that because they are users of these individual companies, maybe they have a Facebook account, maybe they have a Netflix account and they pay for it and they say that everything is great. They're looking at all these other analysts that are saying buy, 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 and so they buy into the stock. They don't know anything about stocks. They don't have any idea about it, but they simply buy in because they think, I really love this company. So many other people love this company. Therefore, I'm going to put money in. And that's not how you invest in stocks. That's called speculation. All right. Now, when you look further into details about FANG stocks or any others, you need to realize what is really going on. We have so many factors. For example, most importantly, what the Federal Reserve is up to. They control these markets. They control the stocks. You may not see that on a daily basis. You may not see that if you're watching exclusively CNBC. If you're looking at these different analysts and asking which stock should I buy, I assure you they're always going to have a different stock to buy no matter how bad the market is. They're always going to tell you which ones to buy. But that's not helping you. Telling you which ones to buy is never gonna help you. You have to figure that out on your own if you want to buy stocks. You can't be the one to say, look, I looked on 3 different websites. They're all giving a buy signal. The price target is way higher than where it is right now, although they may vary on their price targets. Therefore, let's say the lowest price target is $100. I'll sell it at $90. So when it hits 90, I'll sell. Therefore, I'm doing good. No problem. Any of these dips are opportunities to buy more and so on. We've heard this all before, and that's fine, okay? That's definitely fine if you want to do that, but understand the fundamentals, understand what's happening with the Federal Reserve, or you're going to regret it, I assure you, okay? That's all I wanted to say. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, these 2 books have it all. You can get everything you need to know from the foundation, the history, the asset classes, how to make money from all that, how to figure everything that this financial system hides from you are in these 2 books. Check them out at the link in the description below. If you're more interested in the audiobook version, you can get that at themoneygps.com. I just wanted to say thank you very much for all the positivity that you gave me on the last video. I'll say that. Thank you. Thank you very much.